Hello and welcome to this specialist session on the path of the pound. My name is Kate Boulden and I'm a policy advisor in the DC team at the PLSA. And I'm joined by Marcus Fernandes, who is a specialist in currency portfolio management with over 15 years experience in the field and is currently portfolio manager at Berenberg. Today we'll be talking about how the pound will adjust in a post-Brexit world and how AI can give schemes a predictive edge in currency fluctuations. We'll be taking questions in the chat box, so please do add those in. You can also tweet us using the hashtag PLSA Invest21. I'll now hand over to Marcus to tell us more.
Thank you, Kate. So, as Kate said, I'm Marcus Fernandes, a portfolio manager in the investment and risk management team at Berenberg. I specialize in currency, and Berenberg itself has a very deep background in currency. We've had many years in the field, and we have a wide range of clients that we service. So, on to the main topic of the talk, which is the path of the pound beyond Brexit. And to summarize at the start, we see the pound getting stronger. I think that we all know we've lived in the shadow of uncertainty through Brexit. I call it the corridor of uncertainty, and we'll talk a bit more on that as we go through the presentation. But ultimately, with that no longer weighing on us, business as usual cannot continue as usual. Structural change will take shape, and we see the pound getting stronger after this. However, the path it takes is unlikely to be a smooth one, and that's really the crux of what we'll talk about today. How can we navigate through that path? Now, the old tools that we traditionally use to predict the path have dulled in this environment and lost some of their predictive power. We'll cover what they are and why that's occurring at the moment. But in response to this, we've built new tools to help us. And these tools are predictive, and they use things like artificial intelligence, big data, and sentiment. And as we go through the talk, we'll define what all of these mean for the purposes of this talk. But now to go back to the beginning, which is the pound itself, the pound really matters. Now, we all know that, and we all know why, but sometimes it's important to sort of almost restate it, you know why you feel it, but to restate it so that it sets the background for everything that's to come and everything that we talk about. Now, deep down, the pound really matters because we care about our purchasing power. And in a wider world, this means that the exchange rate is important. Whatever you think about globalization, whether it's too much or too little, it's clearly beneficial. There's a balance to be found, but it is here and here to stay, and its balance will change slowly. So this means that on an exchange rate basis, the pound really matters for us being able to purchase the things that we like, which are often made elsewhere. What does this filter back to? Well, we care as pension fund managers and savers about our savers' standard of living, especially when it comes to retire. And the standard of living is then linked to the things that they can purchase, the purchasing power parity, and has an intrinsic link to the pound itself. This is linked also to our investment goals. It's why we don't keep all our eggs in one basket, why we hold foreign equities and bonds. We like to keep pace with the world. When we set our goals, we can use a lot of tech to do that. We can look at the correlation between our investments and the return we expect to get. We look at the time frames. We can do this line by line. There's a lot of computational power out there. But the real important thing is, can I reach my goals by correctly setting the prediction of what I expect to make? And deep down, when it comes to saving and to keeping the purchasing power and standard of living of our savers, the status quo is really a minimum. You at least want to keep things the same, if not better them. And so that's one of the major reasons why the pound itself really matters and why the value of the pound is important. Now, let's then take a step forward and look at the effect of currency on investment portfolios, so we can get a handle as to how important this is and also how it's looked for the pound recently. So On my next slide here, I'll be looking at the currency effect. And what I've done here is I've taken the MSCI World Equity Index, which I'm sure many of you will be familiar with, and I've taken the local version of this. So the local version is a theoretical version, which is currency neutral. So what happens is if I make 5% on my Aussie equities and 3% on my Canadian equities, I just add them together to get 8%. Now, in actuality, you can't do that because they're priced in different currencies and you're adding apples to oranges. But what I look at is the difference between the local return to the currency return of wherever I'm based. So in that sense, I take a currency neutral local benchmark and say, what is the effect of the fact that I have a currency exposure? The first one you see here is the dollar. So if I take the local return and reprice it to dollar as if I was a US investor, this is what I get. And what's important to us here is the size of these bands, because the size of these bands is effectively the percentage currency effect and whether they're above the line or below the line. Now, above the line, your equities have made money because your currency's got weaker. And below the line, the opposite is true. Your equities have lost value because your currency has got stronger. And that's because they're foreign equities. So it's the currency effect that's important. As we go through, I'll stack some extra base currencies onto this chart. So it's a stacked chart, but it's the size of the bands that's important. So if we look at the dollar, you can see the currency effect there. And actually what we're going to see is this is typically smaller than elsewhere, partially because the dollar itself is such a big component of the MSCI world, and also because it's such a central currency. If we add the euro now, what we can see there is the size of the band and the currency effect. You can see from the way that it moves and changes over time why we feel it's very important to manage currency correctly. And also you can see how it's changed sort of conversely to the dollar. Now, here's the interesting one. This is, we've seen if you're a dollar base and a euro base, this is us. So this is us in the UK. And this is the effect that we've faced, and it's something that we're going to talk about a bit more. Now, what you can see very clearly is that in the financial crisis, the pound went from being strong, which is why we're underneath the line, to weak, which puts us above the line. It means our foreign equities gained in value because of the currency effect. What's worth noticing is the size of the band. So there's a lot of currency effect when you have foreign equities. Or fixed income, foreign assets, but also the fact that it's remained above the line for so long. Above the line means your equities have done well because your currency is weak, and the pound has been weak for a while. You can see it starting to potentially correct in 2016, but Brexit pushes it back above the line. And this is the background that we have for the pound over the last, certainly since the financial crisis. Let's just add a few more. So the opposite in many ways is the Swiss franc, another one with a very wide band that became overvalued and still is to many extents overvalued as its safe haven status pushed it towards that. It's something the S&B have been struggling against. So I don't think it's unfair to say that it is overvalued. And then we'll put a couple of the Commonwealth in. So you can see the smaller effect on Canada vis-a-vis the size of the band, but the volatility, Canada's typically volatile because it's linked to commodities like oil, and Australia as well, where you can again see just the sheer size of the band, sometimes the volatility behind it, and the currency effect. So if we look at this chart as a whole, depending on your base currency, you can see the importance of currency and how it really does have an effect on your foreign holdings. So predicting the path is certainly something that can add value to a portfolio. It's not ideal just to sit on a position. We can see that the cyclical changes, whilst they do occur, are volatile in nature. and there's much to be pondered on that. Right, we talked a bit about the band and the pound after Brexit. It was normalizing and then stopped after the Brexit vote, I should say. Let's have a look at that and why that is. And the pound effectively changed its behavior after Brexit. What I have here on this chart is the pound against the dollar, which is the black line, and then an FX emerging market currency basket, also against the dollar, which is the green line. And you can see in the highlighted area, Brexit occurs in 2016. There's a plunge in the value of the pound, and then it begins to behave like an emerging market currency. The ongoing uncertainty about what Brexit would mean saw the market price the pound with emerging market levels of risk profile. And that's the corridor of uncertainty that we've been into, that I refer to. Things kept getting pushed back. Nobody knew the shape the deal would take. And it was just an ongoing thing up until the end of last year, 2020, when the deal was finally put in place, Brexit occurred, and, you know, whatever the change may be, it will now occur. So that cloud of uncertainty, a certain portion of it has lifted after Brexit. And we see the pound correcting and performing after that. But what was interesting for us is looking at managing the pound through that corridor of uncertainty, we can see that it wasn't a really simple oscillating wave. It was messy, it was noisy, it was up and it was down. And we learned some interesting lessons about what has been driving markets through periods like this, particularly with the pound, because it was of the G10 currencies, had some of the most uncertainty associated with it. That's why it had the EM type risk profile alongside it. What we did find is we were able to capture what did and didn't work managing the pound through this period. So now let's talk a little bit about some of the old factors that have stopped working and how the new factors that we use actually gave us some predictive power and showed us what is driving markets. Now, they say if it ain't broke, don't fix it. And here we have the classic pillar strategies of currency management. And I'm sure many of you will know them. We have carry, value, and momentum, okay? The problem is, whilst not completely broken, they have lost a lot of their predictive power. If we look at the first chart, it's simply a stacked chart of central bank interest rates. And you can see clearly that interest rates everywhere have dropped to near zero. They were sneaking back at the end of this chart, 2018, 2019, but COVID effectively put paid to that and everyone cut rates again. Now, carry relies on interest rate differential. It takes the interest rate differential as a guidance as to where currency return will come from. And without interest rate differential, carry loses a lot of its predictive power. Value is another one. We talked about the pound potentially being undervalued because, if you remember our earlier chart, the band had been above the line for so long. And frankly, we have a feeling for that. Back in 2008, 2007, I'm sure we felt pretty good about things when you could go to America and get $2 to the pound. Everywhere felt cheap. Right now, I don't think it's the same. So if you really can't decide where feels cheap, maybe it's you that's undervalued. So whilst we do think there's a certain amount of valuation differential in the pound, if we look at the lower chart, this is the Dixie, or it's effectively a basket of the major currencies against the dollar. So effectively, it's like the dollar power against other major currencies. Because the dollar is such an important part of global trade, it's quite a generalist look at you know, whether the dollar itself is undervalued or overvalued against all other major currencies. And we can see there that it's bang on the 20-year average. So what that says is, using the dollar as the middleman, because it's such a big proponent of world trade, all the other currencies seem to be very near or close-ish to fair value. I mean, there will be some differentials, but if you think about where we are, our reaction to COVID, and in many ways interest rates, it does often feel that we're all on the same starting line. And we often see that valuation occurs when, you know, things are allowed to build up, but it snaps back in times of stress. So right now, I think there's less to go on from a value engine. Finally, momentum is simply about movement. Now, movement still occurs, so momentum still works, but momentum works well when you have sort of the broad sweeps of movement. So you can think of it as sort of the broad sweeps of like a bird flying, rather than just the fluttering moves as it goes sideways. It's the fluttering moves where momentum struggles and strategies have to be more nimble. Movement still occurs, but even that has lost a certain amount of power without the larger trends taking place and the more sideways volatile moves, as we saw earlier with the zoomed in cable chart or sterling against pound during the Brexit period. So if it ain't broke, don't fix it. It's not broken. Let's be clear about that. But it's definitely lost a lot of power and fuel for these strategies. And we know that other things are driving markets. Now it's about finding out what and how that can help us predict the path of the pound, amongst other things. So what does work? Well, it turns out prawns work. To explain that more clearly, I'll go back to a story in financial markets, which may or may not be true, but certainly one that many of us will have heard. And that goes like this. In the 80s, when you were trading Japanese equities, bonds, stocks, etc., and let's say you were a US company or even a UK company, you would have someone situated at Tsujiki Fish Market. And if the fisherman brought in a catch of excess prawns, it was often an indicator that there was deep-lying seismic activity underneath the Bay of Tokyo, which was particularly dangerous for Tokyo being on an earthquake fault zone. So you get a call in the middle of the night and you may start to unload some of your Japanese risk based on the fact that prawns had been harvested in extra numbers at a fish market in Tokyo. Now, it's these types of underlying patterns which may not seem to be intrinsically linked, but which do have power that we are looking for when we talk about what's working now. And let's then explain that a bit more with what we're using to find these patterns. So first up, it's big data, which is self-explanatory. There's reams and reams of data out there. What we use is we use news data. So we take news from tens of thousands of sources and we categorize that data. What's it about? And then after categorizing what it's about, we then look at the sentiment of it. So that's the next step. Sentiment after categorization is a further categorization is this news good? Is it bad? Or is it neither? Okay, so tens of thousands of stories, analyzed, categorized, judged for good, bad, or maybe, and then we apply pattern recognition to that so that we can find those links, like the prawn story, that may exist that help us predict what's driving markets. In a nutshell, it's this level of technology which is now available to us, alongside the sheer mass of data that's available to us, that's allowing us to have a predictive outlook on the market. Why sentiment though? Why is this working and what has changed? So we know that capturing mood and opinion has always been powerful. And now we know that the feedback loop from opinion to action has quickened through technology. I mean, we've seen the power of what Twitter can do on a political aspect almost instantaneously. We're all accessing this conference remotely. Our opinions can be captured almost immediately after we're done, and we could even be talking about this on the chat box right now. So the feedback loop is pretty fast. But 2016 was really a watershed year for evaluating sentiment data. And that's when sentiment data changed, because in many ways, the old way of measuring sentiment was proved to be wrong. And what I mean by that is, if we think about 2016, the surveys that were taken in the run-up to the Brexit vote indicated that Brexit was unlikely. However, the Brexit, or the vote for Brexit, occurred, and a huge amount of value was wiped off financial markets as equities fell, because financial markets had aligned themselves with the old sentiment data captured by surveys. A few months down the line, the US election, again, these same surveys said it was probably unlikely that Donald Trump would become president. And again, they were to a certain extent wrong, well, to a large extent wrong. And again, the market was caught a little bit short in terms of its expectations. Now, why did this happen? It's to do with the nature of the surveys and actually what else you could capture out there. And if I take an example, I could ask the audience, do you prefer working from home, or would you rather go back to the office? Now, it's these sorts of loaded questions which actually affect the answer, depending on who you think may be watching you. However, a better way of maybe looking at what the actual result, or the true result, to asking a question like that would be to capture, for example, news on how much has been spent on office clothing. Have you been buying shirts in the sales or not? Have you been looking at houses outside of your normal office catchment area? These sorts of things give you a more truthful sort of reason as to whether people are really preparing to go back to the office, or if they are perhaps not as much as they may say they are. So these surveys taken outside the supermarket, they didn't really work in 2016. So it was a watershed year. The way in which we capture and use that data has changed. And during that time period, there were people savvy to the way that people's opinions and data could be captured, changed, and used. So with that, is this really an indicator for FX markets? Can we really use this to predict the behavior of the pound? Does it have that power? And the answer is yes. So let's have a little look at how we do this and how it's worked for us for the pound. So the example I'm going to use is the pound against the dollar. So in this chart, you see the pound against the dollar as the black line. This is the indexed value. And the orange line is the position we've taken. So if the pound is falling in value against the dollar, you want to be short the pound or below the zero line. So the orange line would ideally be below that. And if the pound's rising in value against the dollar, conversely, you want to be long the pound or above the zero line. What you're looking for is for the orange line to be leading the black line. So us to take a position before it occurs, and therefore to benefit for it. I'm sure you can see just by a quick look at the chart that there's certainly some predictive power behind the positions we've taken. But let's look at how we get to those positions using all the things we've talked about to get us a sentiment signal. So we're going to build up these signals bit by bit using the processes of how our models work. And at the start, we'll go to the categorizations that we talked about. So if we look at this green bar, this is news categorized, sentimentized about the UK economy. And this is its weighting in the positions we're taking. You'll see as we go through this, we use a combination of classical factors and idiosyncratic factors. UK economy is a classic factor, but you can see it's sort of been fairly staid. News about the UK economy hasn't affected things as much as it would have done previously. Why? Well, I think we all know in this time period, it starts in January 19, we've had other things to think about. Next up is UK politics. Again, it's been pretty steady and level. We've known who's in power and what they're doing. There's been other things that we've been worrying about. I think the next one is particularly interesting, and this is UK societal news. So it's the news about what's going on in society. And the reason it's interesting is to do with the COVID V, which is here in March, where you see the pound take a major plunge before recovering. And this plunge occurred when Italy went into lockdown as the first developed nation. And we knew the pandemic was really very, very serious at that stage. Prior to that, you may recall that a lot of the news had been, we will beat this, we'll come together across Europe in a unified response to stop the spread of this virus, etc. But you can see that the societal models here had turned down and were driving our negative position before Italy announced lockdown. So the news was actually far more negative about the growing number of cases and what was really going on than the market had predicted. And once that news filtered through to structural reality, we saw the outcome. So on that basis, you can see that the societal news had a stronger impact over this period. Over the period of COVID, you'd expect that, no doubt. And here we have one of the idiosyncratic factors. This is our UK Brexit news index, right? And that has been a real strong driver. You can see towards the end of the period, there's almost been Brexit fatigue setting in as the will we won't we rumbled on, and actually we came very, very close to the finish line without a deal. What's interesting for this is that actually it manages to capture towards the end of the period the growing likelihood of a deal within the positive news, and takes a position before the deal was announced by a few days. And then we grow into this longer position, and clearly the pound has been performing, especially after the Brexit deal. So we have the Brexit part of the news. And finally, we have the housing market, the UK housing market. So what we have here is two idiosyncratic factors for the UK. We wouldn't necessarily see these in our other models, but Brexit has clearly been important. And all of us here in the UK will know how important the housing market is to us. They say pick your poison. In the US, they like their 401k. In Japan, they like Japanese government bonds. Here, we're really interested in investing in our houses and within the housing market. So it's a massively important factor, and it's one that's very particular to the UK. Now, this example is a pound against the dollar. So the pound is only one side of it. We also have the dollar factors that we're capturing. So here's the news and the weighting of the news of US economic factors. We can rumble through these fairly quickly because I think the UK ones are probably of most interest to us because we have a feeling for them. This one, though, we'll all recognize, US politics. You can see the weighting of it during the US election, but also during the transition of power, where it also helped drive some of the long the pound, short the dollar story, which you know, helped us generate a return during that period. And finally, US societal news. So again, this has been particularly interesting during the time of COVID. So we use all of these factors to build up the positioning. This graph or this chart is a weighting of these factors. The actual sentiment behind them and how that affects the currency is based on pattern recognition. So it says this good story about Brexit is actually good for the pound because we're here. Or this bad story about US politics is actually maybe good for the dollar because it means change is coming. These sorts of things are all an important and complicated part of the process. But what's very important is that we understand what is going in. We understand what we're feeding these models with. And I would suggest to you that potentially 10 years down the line, if Brexit is still a very important part of this model, then things haven't really gone so well in terms of how Brexit turned out. But you know what the real thing is that things should evolve over time. So the idiosyncratic measures should and can evolve over time, but the old classics I would expect to remain. So it's this that's giving us a lot of predictive power and something that is really driving our growth story and is resonating with people as to how things are changing and how that effect flows through to financial markets. I think probably, I mean, we've gone through it at the top level and built up what on the face of it would initially look like a complex and noisy chart there. The big takeaway from this is that we are in for a bumpy ride. We know that changes can be very swift. We've seen the pandemic take hold, and now we'll see how we exit that. That lends itself to the sort of approach we take here, because if you think about right now, even though this is recorded slightly before, the UK is doing very well on things like the vaccine story. So our rollout of the vaccine is captured through societal news. That's filtered through to the strength in the pound. So we're in for a bumpy ride, but it's these sorts of models that are going to help us navigate our way through it and steer a smoother path. What's important is it's our firm belief that adding future value requires future tools. So looking at things like this is very important. Sentiment is new. The data behind it is new, 2016 being the watershed, but new things are always important, and we adapt to change very, very quickly. How we are holding this conference is simply proof of that. Adoption of the things that drive our sentiment value and the news has happened for all of us. We have multiple news sources. We can respond very quickly to things. We all live a far more online life, and that actually allows us to do things a lot quicker than we did before. That filters through not just from our everyday lives, but through to the financial markets. And it's why it's been such an interesting journey capturing this sentiment data, and why it's such an interesting tool to talk about. I should mention that we still use momentum models alongside it as a confirmational bias. So momentum models help us understand when a move has taken place by looking at the fact that it started to take place. Sentiment helps us predict some of the future. Momentum helps us say, actually, it's working. It's a confirmational method. So with that, I've talked a lot about sentiment and how it's going to help us predict the future of the pound, which ultimately we think is up, but bumpy. I'll probably shift to taking questions through the chat forum, or even if Kate has some questions, we can cover those now.
Thank you, Marcus. That was really interesting and informative. I have a question for you on the types of data used in the model. So over the last few years, there's been a rise in alternative media sources and fake news, which can influence behaviour. Do you consider any of these sources in your model, or do you rely on mainstream traditional media sources?
Sure. Well, there's a lot of traditional sources in the news stories that we capture. So it's not just news stories. There'll be publications from central banks, academics, economic papers, etc. the key thing is we have a filter. There's a filtering process that goes through all of this. So we can capture a whole range of news, but we filter depending on the quality of the source. So if something is published by the Bank of England, it's a quality source that we think will have a definite effect on financial markets. If something's published by the FT, we think it will have an effect on financial markets. If something is published somewhere, let's say, not to be too rude, more spurious, it probably won't, or we will probably filter that type of news out. Now, let's be clear, we have seen some of that news have an effect on things over time, but it's too noisy to rely upon. So we're looking for news that we can rely upon, and also that has pattern forming properties that we can look back on and say cause and effect. This news source is a high quality news source. Once that news was digested by the market, the effect was, and so.
Thank you, Marcus, for a really great presentation. We'll be taking questions in the chat box afterwards, so please do keep adding those in. And if you'd like to talk to Marcus in more detail about this topic, you can send him a connection request. This video will be on demand until the 8th of April, so please do share with colleagues who you think may find it helpful. So thank you again, Marcus, and thank you everyone for joining us today. I hope you have a great day.